Are you a beginner investor looking to build wealth and secure your financial future? Well, you're in luck. In today's video, I'm going to share 4 tips in how to invest in Canada even you're starting from scratch. So grab a pen and paper, take notes, and get ready to start your journey towards financial freedom. Now, a lot of people make the mistake of thinking that investing is only for rich people, and vast majority of us is just doing saving. Well, no matter you're putting away in your savings account or you're putting money in the stock or real estate market, they are all investing. And great news, anybody can get started investing and having the money work for them. Even if it's just $20, $50 or $100 a month, it's good to invest even if you're just setting out because it's important to build good habits early, which will help you later in your life. Now, before you start your investing journey, there are things to think about before you jump in. And I start off with number 0 first, and that's don't invest if you have bad debts as out of control. Bad debt is like credit card debts or payday loans. You always want to pay that money off first before you put money away for investing because you cannot beat a 21.99% interest rate on a credit card. You need to find more secure income like finding another job to make sure you have positive cash flow to invest. Then, next is always start with why. Investment is merely a vehicle that helps you to achieve your financial goals. So, what are your goals and time horizon? Do you want enough money for retirement? Do you want to travel more? Or do you want to pay for your kids' education? These are all things you should consider when thinking about the types of investment you should make. Then consider how long you have before you need to reach that goal. If you have 10-15 years before your kids are thinking about college, you can be a little more cautious than if you only have a couple of years before they need to access that money. Likewise, if you're in your early 20s and you're putting money away for retirement, then you can be a little bit more aggressive than if you're in your 50s and don't have any money saved for retirement. Next thing to consider is your risk tolerance and diversification. All investments, no matter what types they are, have some level of risk. Yes, even you put into a term deposit which provides a guaranteed return, you're still facing the risk of inflation in the long run. Rental properties, on the other hand, may yield passive rental incomes, but facing tenant risk and liquidity risk, meaning during the market downturn, you may get no inquiries even you offer it at a lower price than the market value, and usually take months to complete the transaction. All investments move up and down over time. It's important for you to understand your personal risk tolerance. This means gauging how comfortable you are with risk or how much volatility you can handle. A good rule of thumb is not to put all of your eggs into one basket. Instead, diversify. In other words, don't just put your money into one particular asset like stock market or even just one stock. Otherwise, your entire financial stability is dependent on one company, which is not good at all. By spreading your dollars across various investment tools, you can reduce investment risk. If you want your investments to go up like 30, 50, or even 100%, then be expected you should be okay with them going down by the same amounts. Oh, and make sure you have an emergency fund. You don't want to have to rely on withdrawing from your investment during a market downturn and withdrawing your money at a loss. A really easy way to think about it is, do you have money coming in every single month that you could light on fire, watch it disappear, and you will be okay without it? That's a really good way to know if you're ready to start investing because you have excess cash coming in and you can use it for something now. Again, if you don't have a lot of excess income, that's okay. You just have to start somewhere, and if even that's only $50 per month, that's as good as a place of any. So next is the fun part. Now you've decided what types of investment that you want to do. Next is how do you want to do this? In majority of the investments, you can neither be self-directed or professionally managed. Let's first talk about self-directed. Self-directed means that you personally handpick your investments. For example, you get to pick your own stocks. You can go to self-directed platforms like Wealthsimple or Questrade to do the trading. This type of investing takes more time and effort to do the research. It also requires more financial knowledge about companies and how the market works. You have to be more comfortable reading financial statements, financial news, and paying attention to what the companies are telling their shareholders. Pretty much it costs you time, but you will learn more this way. This also applies other investment too, like real estate, gold, or even cryptos. On the other hand, professionally managed is different. Usually there are third parties involved. It is when you hire an advisor or a wealth management firm to manage your investments. This allows to be completely hands-off if you want. Someone else does all the work for you. They read the financial statements, keep you updated on the markets, and make decisions on what they think is best. Yes, there is a cost to hire those experts in the field, but it will truly save you time, especially if you're the type of people who is super busy or lack of interest. You can leverage that expertise to help you make more money. For example, in the stock market world, there are multiple ways to consider even just for beginners. The first is called a mutual fund, which is an investment that lets people pool their money together into one professionally managed investment. Mutual funds can invest in stocks, bonds, cash, or a combination of those assets. The fund manager will invest according to the fund's goal and buy and sell the underlying investment as needed. So instead of holding one stock generally, one mutual fund can buy at least 100 company of stocks to reduce the market risk. Next, there are exchange-traded fund, or ETF for short, which is similar to mutual fund except there's no fund manager actively doing the trading. Since most of the stuff is automatically, the MER or cost is much lower, hence a better return apple to apple wise. And there are individual stocks where you invest into specific companies like Apple or Tesla. Compared to mutual fund or ETFs, it's more aggressive because you're putting more money into a single company with very little diversification. And they're just the basic products, and there are a lot of derivatives based on that, like margin, shorts, options. It takes so much time and effort to understand each product and strategy. However, I still recommend start with self-directed first so you know what you like and what you don't like, then hire the professional team to deal with the things that you don't like. Alright, the last tip I have for you is to understand the cost behind each investment, because it's not about how much the investment gained on paper, it's about how much it goes back to your pocket at the end. And speaking of the costs and fees, taxes is definitely being one of the highest fee, and there are ways to reduce it legally. But first, let's understand how the game plays. In Canada, when you make a profit on your investment, the taxman will always like to take their cut. For example, when you sold an investment property or certain stock and say you make $100,000 in profit, half of the profit, which is $50,000, will be subjected to your tax bracket, and therefore, in average, you have to pay around 20 to 30% as capital gain tax. Not only that, for stock investment, they might generate dividend, which is like a bonus given by the company, which is subject to dividend tax as well. Or when you put it into a savings account, the interest is subjected to the interest tax, and that's why it's important to start investing into a special account called the tax-free saving account, and by doing so, you can ignore the free taxes that I mentioned above. Now that's just the stock market side. For real estate, there are capital gain tax, property tax, land title transfer tax, and many more. However, if it's your principal residence, you can waive the majority of the taxes. It's important you want to start connecting with accountant and tax experts now. That way, you will always get the first updated news and strategies to beat the taxman. To wrap it up, I will rephrase a quote from Warren Buffett. He said, "The investment market is a device for transferring money from the impatient to the patient." That's why start investing young is always a good thing. Yes, we'll make mistakes along the way, but that becomes our experience, and we'll have time to compound our investment return. Don't forget, Warren Buffett started investing early in his 20s, but his 99% of the wealth did not come until after his 50s. So, happy investing! If you're not sure where to start, please study more or consult with an advisor. Alright, thanks so much for watching. This is Thomas, and I will see you in the next video.